Hello, Tony Marlette Jr. here, Brookside Tax and Financial Group with the October market update. Don't forget to click, comment, and subscribe on our YouTube channel and our Facebook page as well. When we talked about July and August, we thought there were some rays of hope in an otherwise volatile market, but September came crashing back down to reality as year to date, the S&P 500 is down 24%. We find ourselves in a new bear market as well, which means a 20% decline from our most recent high, which actually was way back at the beginning of January. Typically, when we have this sort of volatility with stocks, investors lean to fixed income or bonds. But with interest rates rising this year in an attempt to combat inflation, which has stubbornly stuck around, a diversified bond portfolio is down almost 15% year to date as well. So whether you're an aggressive investor or a conservative investor, you've seen a pretty serious correction. Even gold, which we thought always as a hedge against inflation, is down about 9.5% year to date. We've seen commodities weaken as well, and we're not getting any help globally. Job reports have been strong, but those are starting to weaken a little bit as we're starting to see some layoffs. The silver lining to everything, though, has been company earnings. And since we're at the beginning of the fourth quarter, companies usually report those in the first couple weeks of the month. So look for that to be the highlight of October as earnings remain strong. And remember, in volatile times, there can be opportunities. If you're patient and prudent, you can invest for success. For example, with interest rates going up, those tend to drive bond prices down, existing bond prices down. When that happens, yields rise. Right now, we're seeing bond yields, which are the single biggest driver of income for bonds, at their highest level since 2010. So again, bond yields at their highest level they've been in a long time. We talked about earnings. Earnings are still very strong, but valuations for the S&P 500 are actually below their 5 and 10-year average. And then lastly, by no stretch do we think we're out of the woods with inflation yet, but we think we may have seen the worst of it, even though interest rate hikes and the Federal Reserve has said as much that they will go into next year, 2023, with the goal of raising rates probably until about March. In closing, there's no need to try to time the market. Investors succeed over time by investing with a plan. If you'd like to schedule with us to develop a plan, you can do so on our website or call our office. If you reference this video, not only will your consultation be at no cost to you, you can pick up a complimentary copy of one of our books on retirement planning and estate planning as well. From all of us at Brookside, we thank you for working with us, and we look forward to continuing to work with you.